Recently, I received a lot of requests from students who are interested in lessons on financial reporting and analysis. And in my next series of videos, I will be providing lessons on accounting for assets, accounting for special transactions, financial statements for different entities, preparation of published financial statements, financial statements for interest in other entities, public sector accounting standards, and finally, analyzing financial statements. I will begin this series of lessons with one of the topics which is attracting a lot of interest, and that is this particular topic on financial statements for interest in other entities. This is because under this particular topic is where we have consolidated accounts, which students seem to be so much interested in. This is therefore my first lesson on group accounts or consolidated accounts. The meaning of a group is a situation where one company has invested in other companies in the form of ordinary shares, even though investment in other companies can also be in form of preference shares and also loan stock. But what gives rise to a group situation is investment in ordinary shares of other companies. The investment in ordinary shares of other companies can be summarized as follows diagrammatically. If a firm has invested in another company, A, where the investment is more than 50% of the ordinary shares of company A, then the company A becomes a subsidiary company of this firm. And therefore, it is accounted for according to IFRS 10, which is about consolidated financial statement or consolidated accounts. In the second situation, if a firm has invested in the ordinary share capital of another company, let's say company B, where the investment is up to 50%, then the firm can control company B jointly with other investors. The control of the firm in firm B is therefore exercised together with other shareholders. That is why firm B is jointly controlled entity, meaning the control of firm B cannot be exercised or cannot be done by this firm alone without other investors. In the third situation, the firm has invested between 20% to 50% of the ordinary share capital of the firm C. And in that case, firm C is an associate of this particular firm. There is some control, but the control is very little. Lastly, if the firm has invested in firm D and the investment is less than 20% of the ordinary share capital of firm D, then investment in firm D is purely an equity investment, because here the level of control is very low and therefore may not be significant. In this lesson, we focus more on group accounts, and therefore we shall be talking about a parent company and the subsidiary, and many subsidiaries. A subsidiary company is a company in which the investing company, which is the parent company or the holding company, controls the financial and operating policies. This control is by more than 50% of the voting rights in the subsidiary, which is being held by the parent company or the holding company, or the parent company being able to appoint majority of the directors in the subsidiary board. And finally, carrying out favorable transactions with the subsidiary, which may be, for example, sale or purchase of goods at a price below the market price. These are the three situations where control is assumed to exist. Now, group accounts are prepared according to IFRS 10. They are known as consolidated accounts. IFRS 10 state that the holding company should include the financial results of the subsidiary in its financial statements. This is the process known as consolidation, where the combined financial statements are prepared, and such combined financial statements are known as group accounts or consolidated accounts. Consolidated accounts are accounts combining the results of the parent company or the holding company together with the results of all its subsidiaries. Consolidated accounts therefore include consolidated income statement, consolidated statement of changes in equity, consolidated statement of financial position, consolidated cash flow statement, and lastly, group notes to accounts. So that even the notes to accounts are prepared to recognize the fact that a group exists between the holding company and the subsidiary company. Let us start by understanding how to prepare the consolidated statement of financial position. Preparation of consolidated statement of financial position involves adding the assets and liabilities of the subsidiary to those of the holding company, but excluding the intercompany balances. The following adjustments are very important in preparing the consolidated statement of financial position. First, we need to prepare the cost of control to show goodwill on consolidation, minority interest, groups return profit, groups preference shares, and also the group's loan stock. Then also, intercompany adjustments are important, which include goodwill, unrealized profit on closing inventory, unrealized profit on PPE, intercompany balances, proposed dividends by the subsidiary, and fair value adjustments. These are important in preparing the consolidated statement of financial position. So we shall be looking at this each and every one at its own time. Therefore, you are advised that you also pay attention to the videos that will follow this. Look at the other lessons where each and every item here will be discussed. Let us start by understanding preparation of the cost of control account. The format of the cost of control account is as below. We can use any of the two methods, as you can see here, to prepare cost of control account. In the first method, where we start with the cost of investment in the subsidiary and add to it any shares of the holding company that have been allotted or allocated to the shareholders of the subsidiary. That may happen sometimes that when the subsidiary is being acquired by the holding company, then the holding company can issue its shares to the shareholders of the subsidiary company in exchange for that investment in the subsidiary company. Now, if that happens, then any amount of cash paid plus any shares issued to the shareholders of the subsidiary company, all those are put together as investment. Then from that investment, we subtract ordinary share capital acquired in the subsidiary, preference share capital acquired in the subsidiary, revenue reserves acquired in the subsidiary, and also what's called capital reserves in the subsidiary, plus preference share capital that may be acquired in the subsidiary. All this we add together to determine the shareholders' fund acquired on that date of acquisition. Now, the shareholders' fund acquired on the date of acquisition is subtracted from the total investment above there to determine goodwill on consolidation. This goodwill can either be negative or positive. A positive goodwill occurs when the investment in the subsidiary has a higher value than value of the items acquired here, that is the shareholders' fund acquired on the date of acquisition. But a negative goodwill also exists, but a negative goodwill exists where the items acquired that makes up the shareholders' fund acquired on the date of acquisition is greater than the investment that has been done in the subsidiary by the holding company. In method 2, we have the cost of investment. Then from the cost of investment, we subtract the assets acquired or net assets acquired on the date of acquisition to determine whether we have a positive or a negative goodwill. The first method is the most common method, which is usually used in many consolidation cases. So the second method can also be used, but the most common method is the first one. We also need to determine the minority interest on consolidation. When the holding company has acquired the subsidiary company, but the acquisition is not 100%, meaning they have acquired any percentage between 51% and 99%, meaning not 100%. Now, that means that there are some shareholders of the subsidiary. For example, if the holding company acquires 60% of the subsidiary, then 40% remains to other shareholders. If the holding company acquires 80% of the subsidiary, then 20% remains with the other shareholders, and so on. So whatever remains with the other shareholders is what is known as minority interest. The minority interest is the ownership held by other shareholders who are not members of the group. Minority interest is shown separately in consolidated balance sheet, but as part of shareholders' funds. As part of shareholders' fund, but shown separately. It is made up of the following: minority share of ordinary share capital, minority share of reserves, that is capital reserve or revenue reserves here, and also include minority share of preference share capital. Minority share of preference share capital is also part of it. Now, this makes up the minority interest. Let us also understand the group's retained profit. The subsidiaries' retained profit belong to both the holding company and the minority interest. The holding company and minority interest on the subsidiaries' retained profit. The share of that retained profit that belongs to minority interest is transferred to minority interest account. But then the share that belongs to the holding company is accounted for as follows. First, pre-acquisition retained profits. These are retained profits on the date of acquisition, or that exist at the date of acquisition. Such retained profits are acquired on the date of acquisition and therefore should not be included in the statement of financial position as retained profits. Instead, they are used in computing goodwill on the date of acquisition. After that, they are not shown separately as retained profits. Then we have post-acquisition retained profits. Such retained profits relate to the period after acquisition of the subsidiary, and therefore they are shown separately in the statement of financial position and can be distributed out to the shareholders of the holding company as retained profit or as dividends. Now, the group's retained profit consists of the following. The holding company's retained profit, that one belongs entirely to the shareholders of the holding company. And then the holding company's share of post-acquisition retained profits in the subsidiary. When we talk about the subsidiary's retained profit, it's shared between the minority interest and the holding company. So we only take the holding company's share, and it is only the holding company's share of post-acquisition retained profits. We add that to the holding company's retained profits so that we get the group's retained profit, which is now the total of the two. Let us also talk about preference share capital in the subsidiary. Preference share capital does not lead to ownership in the subsidiary. Therefore, if the holding company owns part of the preference share capital in the subsidiary company, the percentage of ownership will not be a basis for consolidation, will not determine whether to consolidate or not. But preference shares are acquired during acquisition and will still be used to compute goodwill on consolidation. So when determining the goodwill on consolidation, preference shares are included. The other balance on preference shares belong to minority interest and therefore is part of the minority interest included in the minority interest account. Lastly, let us understand the group loan stock in the subsidiary. The holding company may also invest in the loan stock in the subsidiary. This is by issuing the subsidiary with a loan, or sometimes they may buy part of the subsidiary loan. That is, they pay off some of the creditors and then they become the creditors of the subsidiary company. In this case, the loan stock will not be used to compute goodwill, but instead loan stock cancels out with the liability that is appearing in the subsidiary's consolidated balance sheet, with the subsidiary in the consolidated balance sheet. So only the loan stock that belong to the third parties is shown in the statement of financial position. Whatever the loan that is owed to the third parties is what will appear in the consolidation. And therefore, that means that the loan stock that is appearing in the holding company's balance sheet is third parties liability and therefore included. Then the loan stock that is appearing in the subsidiary company is included, but we subtract the loan stock in the subsidiary that is held by the holding company. If the holding company is holding some part of the loan stock in the subsidiary, then that amount is subtracted. It cancels out with the investment that the holding company has done in the subsidiary in terms of purchasing the loan stock. Therefore, the total of the group's loan stock will be addition of all the loan stock that is a liability to the third parties or an obligation that we have to the third parties. That is the holding company's liability of the loan, and the subsidiaries company liability of the loan that belong to third parties or belong to minority interests, but do not belong to the holding company. The one that belongs to the company is cancelled out with the investment that the holding company has done in terms of loan stock in the subsidiary company. Now, in the next lesson, which will be the second lesson on group accounts, I have illustrated preparation of cost of control account, minority interest account, retained earnings account, that is group retained earnings, and consolidated loan stock account, together with the preparation of a full consolidated statement of financial position, which I have prepared using a fully illustrated example, which you can see here. So it is advisable to have a look at the second lesson also, so that you can be able to apply what we have learned in lesson 1 using illustrated example.